In chapter one of auditing and assurance services, we're really just getting an intro to what assurance services actually means. What is an audit? Why is there a demand for an audit? And really just introducing some of the underlying concepts that you'll see sort of brought up through the upcoming chapter lectures as well. We sort of keep coming back to them. So we'll also kind of get an understanding of what the audit calendar really looks like, right? What's the process that we go through in the different phases of the audit, in addition to learning those fundamental concepts and just some terminology, again, that you'll see sort of used throughout the semester. So just to think about this from a student sort of an educational standpoint, the study of auditing is going to be a little bit different than some of the other accounting classes that you've taken. So I know that in our financial intermediate sequence, our advanced accounting, we really heavily focused on accounting guidance and sort of how to analyze transactions and understand what the impact of those transactions are on the accounting records, the financial statements, where we're utilizing journal entries and figuring out sort of, again, what the impact of the financial statements is for those transactions. Auditing is sort of taking, obviously you have to understand the accounting equation. You have to understand the difference between an asset and a liability. You have to understand what is supposed to appear on the four main financial statements. You have to understand all of that from the intro financial accounting class. But the way that we look at things from an auditing perspective is more logical, thinking more sort of from an analytical standpoint, where we have to understand sort of the business processes of our audit clients and ultimately how those business processes result in financial statements. And again, our job as an auditor is to ensure that those clients are following the accounting rules, but we're not sort of as, looking at things from the perspective of making the entry in the journal, sort of more taking a step back and looking at the application of business processes and following accounting guidance that would allow for the appropriate entry or the appropriate impact to the financial statements to be made. So the class is going to be less technical in nature. I'm going to encourage you to think sort of logically through how an auditor would go about performing some of the different tasks that we're going to talk about. And so really thinking about that critical analysis piece of, the accounting profession, sort of what the focus of this auditing class is going to be. So when it comes to sort of the general business relationship, we can think that there are essentially two general parties involved in every business, right? There's the everyday managers of the organization. So those are the folks that are working within the business, and you can have managers at every level, right? We have executive managers, the chief executive officer, the chief financial officer, the chief information officer. You could have middle level managers that are sort of department supervisors or department heads. You can have, even sort of management level below that before you get to sort of the day-to-day personnel that are sort of performing the business processes on a day-to-day basis. So different levels of management, but they are there working for the organization, and they have all of the insight of what goes on within that business. And then we have stockholders. And so stockholders, as you learned in financial accounting, are investors who essentially give their money to the company in exchange for ownership, in exchange for common stock. And so those stockholders can be individuals like us, or they could be other companies. Companies can invest in other organizations. But those stockholders are not there on a day-to-day basis, right? They don't have that insight into the business operations of that organization the way that the managers do. And so in the text, it refers to managers as agents of the business, and it refers to the stockholders as principals of the business. I don't typically use those terms very often. I sort of just stick with managers and stockholders, but you'll see those terms used in the text, so I just wanted to mention it. But getting back to sort of this relationship, there is an obvious imbalance between the amount of insight and information that the managers have versus the amount of insight and information that the stockholders have. And, it could be argued that both parties still need all of that insight and information. Managers need that insight and information so that they can make decisions for the best interest of the business. The stockholders need that insight and information so that they can decide whether they want to continue to be an investor of that organization. So as it stands in this relationship, there is an imbalance that we call information asymmetry. And so information asymmetry is basically just saying that one group has the information and one group does not. In this relationship, the managers have all of the information and the insight about the business, and the owners don't. And so where this brings our accounting profession into play is through an independent auditor. So the independent auditor is engaged by the organization in order to provide reasonable assurance about the information that's being presented by those managers, right? So it is the manager's responsibility to summarize the operations of the business in the form of financial statements. And so the auditors are then brought in and engaged to provide reasonable assurance that the information, I skipped ahead, that the information that the managers are producing in those financial statements is an accurate reflection of that organization's business operations. So the auditor is going to be engaged to gather evidence and evaluate whether the manager's reporting about the business operations is accurate and is in line with the accounting rules that everybody has to follow. So one analogy that, I sort of experienced personally that I thought would sort of really related well to this relationship, where you have this manager that has all of the information, and then this investor, this stockholder who has none of the information, and why it's important to bring in an independent third party to sort of create more balance in that information asymmetry is through a house inspection analogy. So my family, my husband and I just recently bought a home a year and a half ago. And we were required to have a home inspection done, right? And so the seller of the home, obviously through the selling process, right, provides the details for the home, provides, the square footage and how, when were the windows and doors recently replaced? What about the furnace? What about the air conditioning system? What about the roof? So the owner of the home is, in this analogy, the manager, and the owner of the home has all of that detailed information. They have been in the home, they have all of that detailed information. My husband and I, we were the absentee stockholders, right? We were coming in, deciding whether we wanted to purchase this home, and all the information that we had was based on who the seller and what they gave us, right? So there was this information asymmetry. The seller had all the information. We as the buyer didn't have anything beyond what they told us. So we bring in a house inspection, an independent third party that's contracted, that's engaged to inspect the home so that they can provide the buyer, us, with the details about the home and whether or not it seems to be in line with the information that was provided by the seller. In our example, in our exact situation, the inspection came back saying that the roof was going to need to be repaired within the next 5 years. And so that was not necessarily something that the seller disclosed to us in sort of the reporting that they're required to give us. It wasn't anything dubious. They weren't trying to sort of pull one over on us. They themselves may not have known, right, when the roof had been most recently replaced, or if there was any specific damage that they weren't aware of. So they weren't necessarily trying to pull one over on us. They just didn't know. So this third party comes in and they're able to tell us that because the roof is going to need replaced in the next 5 years, we as the buyer were able to renegotiate our price, because with this new information, we now understood what the home was worth. And so that's the analogy that I like to give. Again, it's just fresh in my mind because we just went through it, of how this independent third party serves to provide some form of assurance to the group, to the party that doesn't have as much information as the other. So there's this imbalance of information asymmetry, and the managers want to provide good, accurate information to the stockholders, but the stockholders want some form of assurance that the information that's given to them by the managers of the organization is relevant, reliable, it can be comparable across different periods and across different organizations, and that it's following the accounting guidance in the correct way. So that's why there is a need for the independent auditor. That is the focus of our class, right? This audit profession and how this third-party independent auditor provides this assurance. So the way that this essentially works, right, is that the managers of the business are going to prepare their financial statements, including footnotes. And those financial statements are going to be available for public consumption. For companies who have their shares publicly traded, they provide that information on a public forum, right? Their financial statements and their footnotes are provided on a public forum. By doing so, the managers of the business are basically making declarations or assertions about how that business performed during that period. So I'm going to jump ahead a couple of slides here to talk about these management assertions. So what is it that management is asserting about the transactions of the business? Well, by preparing those financial statements, management is asserting that all of those transactions actually occurred, that the financial statements are a complete representation of those business transactions, that all of those transactions have been authorized in accordance with the business's company policy, that the amounts included in those transactions are accurate, that they have cut off those transactions to sort of separate out the given accounting period, that those transactions have been classified in the correct account. So think of something like something that's a current asset versus a long-term asset, or a current liability versus a long-term liability. And they are asserting, management is asserting that they have presented those transactions in accordance with the accounting guidelines. In addition to those assertions that management is making about those transactions, management is also making assertions about the account balances that appear on those financial statements. They are asserting that those assets, liabilities, and equity interests actually do exist. They are asserting that the organization has the rights to all of those assets and has the obligation to pay all of those liabilities. Management is asserting, again, that everything that should have been recorded in their financial statements has been recorded. It is a complete picture of the financial interests of the business, that all of the assets, liabilities, and equity interests have been evaluated accurately, so they are at the correct dollar amounts, that they have been classified correctly, and again, presented in accordance with generally accepted accounting principles. When management prepares their financial statements, this is what they are asserting about those financial statements, right? They are asserting all of these things about the information that is presented in those financial statements. Then if I jump back to slide number 6, the auditor's job is to examine evidence related to those management assertions. So I'll give you a quick example, right? So we said one of management's assertions is that the balances actually exist on the financial statements. So let's say we're talking about assets and we're looking at cash. If management is asserting that cash actually exists, then it is the auditor's job to gather evidence so that we can provide reasonable assurance that yes, cash actually does exist. So the type of evidence that we would gather as the auditor would be something like a bank statement. We can send a direct confirmation letter to the bank to request that they confirm what the balance was at the end of the year. We can gather evidence about that cash account where we can then say, yes, we agree with management's assertion that this cash actually exists. So management makes these assertions about the financial statements that they prepare and they allow the public to consume. And it is the auditor's job as a third-party independent service provider, it is the auditor's job to gather evidence about those management assertions so that we can provide a sense of assurance to those stockholders who can't be there and they can't review the financial statements in detail. Those stockholders can't review all of this evidence to make sure that, the financial statements are an accurate picture of the business operations. The stockholders can't do that, so they engage us, and it is our job to provide that type of assurance. So I skipped ahead a little bit, right? So we talked already about management's assertions and the auditor's responsibility to gather evidence about management's assertions. Now let's think a little bit about the audit process. So this slide gives an overview of our sort of overall audit process for our clients' financial statements. So you see at the top are sort of the two parties, management of the organization and the auditor. Notice that the stockholders are sort of missing from this diagram. The stockholders really don't play a part in the audit process. So they are not sort of a constituent that is involved in our audit process. We, as the auditors, will ultimately want to report to the stockholders. So when we, at the end of our audit, and this is going to come in the last slides of this lecture and then in future lectures, at the end of our audit, we are required to sort of report out our findings. That report is actually addressed to the stockholders. So the stockholders are our primary audience, but they are not involved in the audit process. So management and the auditor are going to form terms of engagement. So we are going to try to figure out, right, the timing of our audit, when are we going to perform our audit procedures, what are the fees that are going to be involved, all of the sort of the contractual arrangements that we have with our client. Management then, on an ongoing basis, is conducting business processes, implementing internal controls, and basically recording business transactions in their accounting system. And so as management is doing that, it is our responsibility as the auditor to, on an ongoing basis, gather evidence, not only about the transactions that are being processed, but also about the company's internal control. So we're going to talk more about this in a future lesson, but essentially the auditor in the case of a company who is publicly traded, meaning that their stock is available on a public exchange, the auditors are required to actually perform two audits at once, essentially. And so we are engaged to audit not only the financial statements, which is really the primary part of our engagement that most people think about. When you think of an auditor, you think of, okay, they're looking at the financial statements or the financial reporting of the company. That's only one piece of it. The other piece of it is we are engaged to also figure out whether the company has implemented a good system of internal controls. So not only are we gathering evidence about the transactions that they're processing and the account balances that are accumulating in their financial statements, we also are going to be gathering evidence about the company's internal controls. The company then is going to prepare their financial statements, and we would have to, as we gather that evidence, we would have to determine whether we believe that those financial statements have been prepared in accordance with GAAP, and we would have to basically form an opinion on whether we think their internal controls are operating such that their business processes are moving along as they should, right? So the auditor is gathering evidence, and then we form an overall opinion about whether we think the financial statements are in accordance with generally accepted accounting principles and whether we think that their internal controls are working. We issue our audit report in conjunction with the financial statements. So before those financial statements, they are prepared by management, but before they are issued for public consumption, we, as the auditor, have to write our opinion report, and that audit report gets included in those public financial statements. And so that's one activity that we're going to do later on in the semester. Students are actually going to go on to the SEC website, find the financial statements for a publicly traded company, and find their audit opinion, because they're embedded right in the financial statements along with the balance sheet, the income statement, statement of cash flows, and all the footnotes. So this, again, is an overview of just sort of the process that we go through and sort of what role management plays and what role the auditor plays. Now, no matter what kind of client you're working for, right? So there are clients in a variety of different industries that would need an audit performed. There are clients that are in insurance companies. There are clients that are in service organizations. There are clients that are in retail. There are, just across food service, across the board, right? No matter what kind of audit client you are performing the audit for, there are three underlying concepts, fundamental concepts, that are going to serve basically as the foundation of every audit that we conduct. So again, big client, small client, different geographic locations, different industries, doesn't matter. while the specifics of how we conduct the audit will be dependent on the type of client that we're working for, these three underlying concepts are going to be embedded in every audit that we perform: audit risk, materiality, and evidence. So audit risk is the risk that we would issue a clean audit opinion. That basically means that we would say, we are reasonably assured that there aren't any mistakes here in these financial statements, right? That's what a clean audit opinion, that in the industry, we call it a clean opinion. The audit risk is that the risk that we would issue that clean opinion when in fact there actually was mistakes in those financial statements and we did not find them or catch them, right? And so you think to yourself, okay, well, isn't that the whole point of the audit, right? Why is still there this risk? Well, when we engage as an audit firm with a client, we make it very clear in our contracts, in our documentation, in everything that we do in our final audit report that we hand over, that we are only providing reasonable assurance. We do not have, as the audit firm, we do not have the time and resources to gather evidence about every single transaction that occurred, every single dollar amount, right? Think of large organizations and how many transactions they process in their accounting system in a day, right? Let alone an audit period, a full year of transactions. We don't have the time and resources to gather evidence about every one of those transactions, every dollar that appears on the financial statements. And so we are only providing reasonable assurance that there are no material mistakes that went on in those financial statements. And again, we will reiterate these concepts as we work through the future lectures, but at its core, audit risk is just the risk that because we can't audit everything, we don't have the time and resources to gather evidence about every single thing, we can only provide reasonable assurance. That means that there is still some risk that there may be misstatements or mistakes that occurred in the financial statements that we did not catch, that we did not find. Reasonable assurance, right, is related to audit risk. And then we get to materiality, right? Materiality was actually used in the explanation of audit risk. So what is materiality? Materiality is essentially, what do we deem to be important for this audit client? Okay, so materiality means that if someone would have known, and that someone being a stockholder or a bank that's trying to give a loan to that organization, any sort of constituent that has a decision to make, and they are using those financial statements to make that decision, had they known about that mistake or omission, they would have cared and it would have changed their decision, right? That is what materiality means. And again, that's a very subjective definition that I just gave you. In chapter 3, when we move on to sort of getting into how we prepare for our audit, in chapter 3, we're actually going to learn how to calculate materiality. So we can put a dollar value to our materiality and say, okay, based on our calculation, we believe that any dollar amount, any transaction, any account balance that we see on the financial statements that is above this threshold, this materiality threshold, that is a dollar amount that we care about. We think that if that amount was omitted or there was a mistake in it, someone would care about that. It would change someone's mind about investing, about lending. Think about working for the company, or maybe someone who's going to be supplying the company with raw materials and supplies. All of these different constituents have decisions to make, and they use the financial statements to make those decisions. With materiality, what we are trying to figure out is what is an important amount to those constituents. When they are making a decision, what amount would actually change their mind? If it was omitted or if it was a mistake, would it change their mind? That's materiality. And you can imagine that materiality, the thresholds are not going to be sort of one size fits all. The materiality threshold that we come up with for Target is going to be different than the mom and pop retail store sort of in the square of our town. So the materiality threshold, the dollar amount, is not going to be one size fits all. We're going to learn about some techniques that we can use to calculate materiality, and it's going to in those calculations, it's really going to be influenced by the size and complexity of the organization. So we'll get to that later on in chapter 3. And then finally, the last sort of underlying fundamental concept of all audits that we would conduct is evidence. So evidence is what we gather both from internal sources like the client themselves, the company themselves, and external sources. So we may talk to the client's suppliers, or we may talk to the client's lender, or we may talk to the client's customer. So we can go to a third party and ask them to provide us with information that is going to allow us to form conclusions about management's assertions. So again, I gave you the example of cash. We said that management is asserting that cash actually exists. And a piece of evidence that we would gather about the existence of cash could be the bank statement. So we could ask the client to give us a copy of their bank statement, and we would be able to see what that bank statement says in terms of the balance at the end of our accounting period. If that balance lines up with what they've presented on the financial statements, then that evidence serves as proof that the cash actually exists. So we are gathering evidence, again, both internal and external evidence, in order to form our conclusions about management's assertions. And when we are gathering evidence, we want to be concerned with sort of two characteristics of that evidence. Is it relevant, right? Is the evidence that we have gathered relevant to the specific thing that we're trying to get proof of, right? So if we're talking about a cash account, right? If they give us a contract for a leasing arrangement that they have for the building that they operate in, that is not relevant evidence for the existence of cash, right? That might be relevant evidence when we're thinking about how do we audit their leasing liabilities, but that's not relevant evidence for the cash account. So is the evidence that we have gathered relevant to what we're trying to have proof of? And then reliability. Can that evidence be relied upon? So again, if we think about the cash example, the evidence that we gathered was directly from the client, right? And we kind of want to go into that evidence with a sense of professional skepticism, what we call, right? We don't want to automatically assume that, oh, because the client gave us that evidence, it's not reliable. They're trying to pull one over on us. That's not the assumption that we jump to all of the time, right? But we may be able to gather more reliable evidence if we go directly to the bank and ask the bank to confirm the existence of cash, right? We could write the bank a confirmation letter. You're going to see this come up in some of our case studies. We can write the bank a confirmation letter and say, hey, can you please confirm that at the end of the year, this client of ours had a certain balance of cash? That would provide more reliable evidence about the existence of that cash. Again, that doesn't mean that we don't accept any evidence from the client. Actually, the majority of the evidence that we gather is going to be from the client themselves. But we may be able to provide more assurance about these assertions if we go to a more reliable source, right? So an external third party would be considered a more reliable source. So those are our three underlying concepts: audit risk, materiality, and evidence. You will hear them get brought back up over and over again as we sort of work our way through this audit process in the upcoming lectures. One other thing that I want to make mention of that kind of relates back to audit risk is this idea of sampling. So with audit risk, I said there's always a risk that we may form the wrong opinion. We may say, hey, everything looks good. This is a clean set of financial statements, when in fact there were actually mistakes in those financial statements that we just didn't find. And the reason why we may not find those financial statements, one of the reasons why, is sampling. So think about a transaction that a company would process thousands of times during an accounting period, right? Thousands of times a company would process the receipt of cash from their customers. Thousands of times a company would process transactions related to the purchase of supplies or raw materials or other inventory items, right? Thousands of these transactions. And we cannot gather, as the auditors, we don't have the time or the resources to gather evidence about every single time that transaction is processed. And so what we would do is we would gather a population of those transactions for our audit period, and we would sample out just a certain number of those transactions, and we would only gather evidence about that sample rather than the entire population of all of the transactions. So sampling is going to be necessary because we don't have the time and resources to gather evidence about every one of those transactions. But sampling comes with an increase in our audit risk. If you are only examining evidence about a small sample of a larger population, then that can increase your overall audit risk. So we sort of have this balancing act of figuring out how much audit risk are we willing to bear, and so how much, sampling are we going to do within our audit procedures, within our audit program. And we'll come back to all of these underlying concepts in later semesters as well. So now getting into some of the major phases of the audit, and you can see here, I've also detailed out sort of how we're going to progress through them in the upcoming chapters. Chapter 2 is going to be, again, another introductory chapter where we're really learning about basic concepts, getting through some terminology related to the audit process and all of that. Where we sort of get into the actual phases of the audit is going to be in chapter 3. In chapter 3, we're going to talk about how do we decide whether we want to actually engage with that client or not. So we want to continue providing audit services, or maybe we want to start anew with a client and start doing their audit for the very first time. And then some of the preliminary activities that we have to do, making sure that we have a team available, making sure that our contract is in place with that audit client, all of those kinds of things. We actually go through an extensive planning process where we want to assess the risk of this client that we are auditing. We want to be able to calculate what our materiality thresholds are for that audit client. And we want to make sure that we understand what kinds of evidence are we going to gather for the audit for this client that we're conducting the audit for. We want to make sure that we understand their internal controls, and then we want to audit those internal controls. So that's going to come in chapters 6, 7, and 8. Then we want to actually look at all of their main business processes, and we want to audit the accounts that are related to those main business processes. So you see here, we're only covering chapters 9 and 10. Those chapters are focused on the revenue process. We just simply don't have time to cover every single main business process in our auditing class. But what we would also do in a real world audit is not only just audit the accounts related to the revenue process, but we would also audit accounts related to purchasing, related to human resources and payroll, related to long-term asset management, related to inventory management. Those are the main business processes that most organizations have embedded in their process, and we would want to gather evidence and audit those business processes. But again, in chapter 10, what we're going to focus on is going to be the revenue process. Once we would have conducted our audits of those business processes and the related financial statement accounts, we'll have some sort of loose ends that we have to tie up, some sort of, we want to wrap things up in a nice bow before we're done with our audit. So completing the audit, there are some general procedures that we have to perform for our clients. And then finally, we would want to form our overall opinion, and when we would want to issue our audit report. As I mentioned earlier, that audit report gets issued directly with the financial statements of the audit client. So we have a templated audit report that we would issue. And again, we make adjustments based on findings that we've had for a particular client. So I do want to touch on that audit report quickly here, an introduction to what the audit report is, what it includes. But we get into much, much more detail about that later on in the semester. But for public company audits, we have to issue our audit report to the shareholders of that organization. And in the title of our audit report, we have to be very clear as to the fact that we are an independent registered public accounting firm. So that means that the folks who are signing off on our audit report have to be CPAs. So if you are working for a public accounting firm, as you move your way up sort of the hierarchy, you have to get that certified public accountant's license. That is the way that the audit firm is representing that they sort of have the qualifications and the criteria in order to issue this report. And again, the more important word here in the title is going to be independent. We are an independent third party. We have no skin in this game. We have to make sure that we have no extensive affiliations with those audit clients, because our independence gives us credibility. When we're issuing our audit report, we want to provide reasonable assurance about whether those financial statements are an accurate reflection of the business organization. And in order to do that, we have to have credibility. This independence is going to give us that credibility. So basically, our audit opinion is going to explain what rules guide our audit. It's going to explain the time period that our audit covered. It's going to provide our opinion, right? What do we think about these financial statements? Do they appear to be prepared in accordance with our generally accepted accounting principles or not? And then we also just recently added a section of critical audit matters. So these are sort of complex accounting issues that we encountered during our audit that we want to sort of bring to the reader's attention, just so they are aware that yes, we did have some complicated aspects to our audit, but it wouldn't change our audit opinion necessarily. Just again, bringing some complex areas to the forefront. The audit report will then conclude with the signature of our accounting firm. We, again, this little red star is a new addition to the audit report. We now have to list in our audit report the year that we began conducting audit services for the client, the city and state in which the report was issued, and then overall the date. So that's sort of just an overview of the information that gets included in the report. And again, later on in Chapter 18, we're actually going to walk through the audit report together. This is just sort of an introduction. Now, when it comes to this audit report, as you can see, right, there's an outline provided. We don't come up with this audit report off the top of our heads. There's an outline that we follow. And when it comes to the type of audit opinion that we give, again, we don't come up with that off the top of our heads. There are 4 choices that we have. We can issue an unqualified report. We can issue a qualified report. We can issue an adverse report, or we can issue a disclaimer. So one of these 4 we have to choose from, okay? The unqualified report is the one everyone wants. This is the thumbs up opinion. We are reasonably assured that there are no material mistakes in these financial statements. That is the unqualified standard opinion that everybody wants. That's the thumbs up that everybody wants. All of the clients want that. But we may encounter some areas in our audit where there were material misstatements, but it doesn't have an impact to the overall financial statement picture, right? And so that's where we would issue what's called a qualified opinion. We would say, except for this area, everything else is reasonable. We are reasonably assured that everything else is free of material misstatement. And then we would have to describe in that area that we are making the exception for, we would have to describe what was it that we found that is not in accordance with the accounting rules, right? So again, unqualified is the thumbs up. Overall, everything looks good and we are reasonably assured that they are in line with the accounting rules. Qualified is where we have to identify a particular area that, yeah, we did find some mistakes here. Those are material mistakes, but the overall picture of the financial statements is sort of thumbs up, looks good. Adverse is the third option that we have. And adverse is where we have found so many financial statements that we would say we are reasonably assured that these financial statements are not in accordance with the accounting rules. This is the thumbs down opinion, right? We are reasonably assured that these financial statements have not been prepared in accordance with generally accepted accounting principles, thumbs down. That's the third option. And then the fourth option is where we either figure out at the end of our audit that we are not independent of that client, which that is something that never happens, right? Throughout our audit period, we want to make sure that we are ensuring that we are independent of that audit client. We should have no skin in the game as to the results of our audit procedures. And we would want to make sure that throughout the audit period, we continue to be independent. But if it happens that we figure out at the end of our audit, we've done all of this work, but we are not independent, or we are not able to gather enough evidence from that client in order to form an opinion. In either of those circumstances, we would issue what's called a disclaimer. And a disclaimer is basically saying we have no opinion. Either we figured out that we are not independent and therefore we can't issue an opinion, or we were not able to gather enough evidence to actually form our opinion. In either circumstance, we would disclaim our opinion. We have no opinion on these financial statements. So we're going to go through, again, this in much more detail at the end of the semester in the very last chapter, but I just wanted to introduce you to the fact that the audit opinion, the audit report that we issue is not something that we, each firm does in their own way. The entire profession is following a template and has to pick from one of these 4 types of audit opinions. So we're all sort of following the same outline for issuing our audit report. And then just to sort of conclude sort of where we started the conversation here in chapter 1, when we are looking at the financial statements of our client, we want to think logically. We want to really understand, logically speaking, how the business processes of our client result in these financial statements. It's really important to just use your common sense and reasoning skills as you think about the ways that the auditor would approach the financial statement audit and the internal control audit of their clients, is to just think of common sense and sort of reasoning, logically thinking your way through the business processes of the client and what makes the most sense of how to approach gathering evidence about their business processes, their internal controls, and their financial statement amounts. So, again, it's a different perspective than a lot of the other accounting classes that you've taken, but I hope that you will find this as sort of sharpening a different set of tools, a different set of skill sets as you work your way through the accounting curriculum in our program.